looking at stocks versus bonds and the narrative that is being communicated by the two different asset classes, right? Seeing bond yields go higher, while we see stocks have sort of vacillated as of late, but we've seen some enthusiasm for stocks. So what are the two narratives, and which of them is going to end up being correct? Tell us right now, Stephen.
Well, here's the thing. Stocks and bonds can and do diverge over time. And I do think it comes down to fundamentally there are two different types of investors. Bond investors, they just care about getting paid. They know what their upside is. It's getting all your principal and all your interest payments on time. So they're focused on what can go wrong. What's going to disrupt me from getting all those payments as promised, or am I paying too high of a present value? Stock investors are optimists by definition. You wouldn't be investing in stocks if you weren't optimistic. And so stock investors are thinking of what can go right. Bond investors are thinking of what can go wrong. That's an oversimplification. But so what happens is, on a day like Monday, which was staggering, where you had this big backup in bond yields, but you had a fairly narrow mega cap tech-led rally, that epitomized that distinction where you had stock investors saying to the moon and bond market investors saying, I'm not so sure. Ultimately, I called that yikes versus YOLO because the bond market was freaking out and the stock market basically said, let's keep buying our favorite stocks, which one of them was NVIDIA, and it worked. But so going forward, ultimately, when the stock market and the bond market diverge, the bond market tends to be right when it comes to views of the economy.
One of the interesting things that jumped out to me in your note is that we're probably seeing an oversold bounce in the bond market. Can you explain that a little bit further for us?
Yeah, yields got high enough. Remember, bond prices and yields move inversely in bonds. The yields got high enough, the prices got low enough that, like any other investors, people saw value in it. They said, okay, maybe 430 on a 10-year is not a bad place to be. When you're starting to go further out on the curve, there are people who use it as a trading vehicle because there is enough volatility to actually trade the 10 years. You're not really going to trade the 2 years; it doesn't move very much, but you are going to trade the 10 years. And so I think people really said, you know what, the rates have backed up enough. Bonds have gotten a little bit cheap. Let's maybe lock in some long-term rates.